Hi friends, welcome to our channel, Create Your Wealth. You would have seen our other videos on our channel. One of the most popular video that we have on our channel is the description or the narrative of the book How to Avoid Losses and Earn Consistently in the Indian Stock Market. If you have not listened to that video, I would request you to do so. The link of the video is in the description given below. Based on one of the requests, I had also made the videos both in Hindi and English, where we understood about the various concepts or the various stages through which Rohit passes and how he, and what are the things that one must not do. Now we need to go further to understand what are the simple concepts within the stock market so that we understand how we should earn the profit. Today's topic we are picking up is a value versus price. There is a lot of confusion that happens when we say what's the price of the product or what's the value of the product, and we use this term synonym when at least it comes to an Indian context, right? So we say what's the value of the watch that you bought, you say it's 100 rupees, whereas what's the price of the product, we say it's 100 rupees, right? But when it comes to the stock market, we need to understand these two terms very clearly. To understand these two terms, I would also be explaining you the other terminologies as and when we proceed further. Let's say that you have started your own business with a capital of 1 lakh rupees. Your business has been doing really well and you made a profit of 20,000 rupees in the first year. You were very happy with the results because it was a 20% revenue, and this revenue was, or the profit was, after you made all the bill payments and taxes and other liabilities. You decide to reinvest this profit back into your business. Currently, your working capital has become 1.2 lakhs, the initial 1 lakh that you had invested plus the 20,000 profit that you had got. Now, your business kept growing year after year. This next year, you made a profit of 50,000, and the year after, you made a profit of 90,000, and so on. And this reached to a stage where your working capital reached a amount of 5 lakhs rupees. You have been doing really well and have now plans for expanding your business. You speak to one of your friends and say that I want to expand my business because I have started with a profit with an investment of 1 lakh and have reached to a profit of 5 lakhs. Or I can say that I have reached to a stage of having a capital of 5 lakhs. But I want to grow further and I need 10 lakhs rupees for expansion. I already have 5 lakhs and I need the remaining 5 lakhs more. Your friend says instead of trying to raise the capital by taking a loan, why don't you try to raise the capital by issuing shares? Shares? How shall I issue that? Can you please explain me further? So he says, let's say now that you need a total of 10 lakhs rupees for expansion. You already have 5 lakhs with you, right? I said yes. Since your name in the industry is very well known, all your stakeholders are very happy with your business and the way you perform your business. They have a lot of trust in the way the management works and they have a lot of confidence in the vision of your company. I said definitely yes. So now let's proceed further. There's an important term which is called as the face value of the business. Face value? Can you please explain me further? Yes, in an Indian stock market, we see that the face value is rupees 10, 5, 2 or 1. So now let's decide that you are going to issue the shares with the face value of rupees 10. Okay, so how many shares should you issue? So I need a capital of 10 lakhs and I have the face value of the share I'm planning to issue is 10 rupees. So 10 lakhs divided by 10 rupees is obviously 1 lakh shares. Right. But currently, as you said, that you already have 5 lakhs with you. I said, yes. And you are the owner of the business. I said, yes, true. Then, so 50% of the stake of your company, that is nothing but 50,000 shares, belong to you. And that is nothing but the promoter holding. Okay. So the face value only decides the number of shares a business can have. Okay. And face value is with respect to the capital only. So 10 lakhs was the capital that you needed for your expansion. So, and you wanted to issue the shares of a face value of rupees 10, you went ahead and issued 1 lakh shares. Going further, we wanted to understand one more term. that is the net worth of the company. Because if you wanted to get listed in the exchange, either the National Stock Exchange or a Bombay Stock Exchange, you need to actually decide the net worth of your business. And how is the net worth calculated? Net So net worth of your company, how is it calculated? It is calculated as the total assets minus total liabilities. This is calculated as, for example, in your company, you have assets worth rupees 50 lakhs. It includes all the reserves, the sales income, the inventory at your warehouse, etc. And let's suppose that you have liabilities of rupees 10 lakhs, which is nothing but paying to your creditors and other types of liabilities. Then the net worth is equal to 50 lakhs minus 10 lakhs, that is equal to 40 lakhs. Now, let's go to the next stage, that is the book value and its calculation. So, book value is nothing but calculated as net worth divided by the total number of shares. So, as we saw that the net worth is 40 lakhs rupees and we had issued 1 lakh shares, the book value is equal to 40 rupees. Hence, the book value is the value of your company as per the books and the balance sheet. And this deals with the net worth of the company, which is based on the number of shares. So, good friends, that market value of the share. What is it? Market value of the share can be either less than or greater than the value as per the book value of the share. Market value purely shows how confident the investors are in the business. Moving forward, if the market believes that the company has got an amazing future earning potential, the market value will be much higher than the book value. However, if the market feels that there is not enough potential or in the future for the business, the market value of the share might be much lower than or equal to the book value. Market value is the price of the share that is listed in the market. It is not only based on the book value, but it's also based on the future potential of the business, the confidence the investors have, the sector, the market sentiments, and other operators, insiders, analysts, newsmakers, and many other factors which contribute to the market value of the share. So the market price need not necessarily be the value of the share, which which means that if the sentiment and the fee and the confidence the investors have and the demand and supply of the equities in the share market will drive the value or the share in the stock market. Given the investors entry and exit points, they might be called as the value of the share. We will slowly cover all the other concepts that are listed on the screen, and keep watching this space for more. Thank you for your support.